Welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. And this week's topic is how to handle your estimated quarterly taxes. This is a really great topic because we get this a lot from business owners, trying to understand whether they should make estimates, how much to make in an estimate, and so on. So we're going to talk a little bit about that today. So, um, you know, and your estimated taxes, they matter for your income tax because if you don't contribute what you should be in taxes throughout the year, the very short story is you're going to get charged penalties and interest for underpaying your income tax throughout the year. And that's where sometimes it can get a little bit expensive for clients. So we'll talk a little bit about penalties and interest and those kinds of things. And also who really needs to make quarterly estimates. Typically, it's going to be someone who's self-employed. It's going to be a business owner, someone who acts as an independent contractor, and then also an individual who is actually earning income outside of, for instance, if they have a W-2 position, if you're earning income, passive income, rental income, investment income, etc., outside the scope of your wages, you may want to make an estimated tax payment. So kind of what exactly are, estimated quarterly taxes? So you're basically paying your taxes throughout the year instead of paying like a big lump sum at tax time. So when you work for someone else, you are periodically paying into the tax system every time you're paid. And so when you work for someone else and you have that withholding getting remitted on your behalf on a regular basis, in most cases, and I'm not saying all, but in many cases, you are covering what your tax liability is when you file your tax return. That's the reason why a lot of times, and I'm not saying all the time, but a lot of times, let's just say a married couple, two adults, both have jobs, both paying into the withholding, typically we'll see some type of refund when they actually file their tax returns. In most cases, most of what we see anyways, those handful of clients will not have a balance due. Again, as I mentioned, is if they have income coming from other places, that's not included when you're figuring out your withholding. But for the average W-2 employee, if you're withholding properly, you typically have enough to cover your tax liability. So in most cases, those types of individuals are not typically making the estimate. Whereas, again, you've got a business owner, somebody who has a Schedule C, someone who has a pass-through entity, they might be on their payroll, the payroll of that entity. But again, there's income from the pass-through and so on that kind of gets calculated in there. But we'll go into that in a little bit. So if you think that you're going to owe at least $1,000 or more when you actually file your return, you need to be making quarterly tax payments. And they're not exactly on the quarters. We'll go over the actual dates in a minute. But you want to be able to cover what you think your income tax obligation is going to be. And that includes, if you are self-employed, that's your self-employment tax. If you are a high earner, that is the additional Medicare tax, right? There are all different like small taxes that come into play once your income starts to get up there. So those are all the things you want to think about. So again, as I mentioned previously, if you're a couple, two individuals that are W-2 employees, I've seen people like that owe before, but in most cases, you typically do have enough funds to kind of cover what that liability would be in all of the withholding that you had submitted, throughout the year on your behalf from your employer. So how are you going to calculate this tax? So there's a couple of different ways that you can do it. The first and kind of the easiest way to do it is you use last year's tax return as a guide. So typically, when we finish doing a tax return, one of the things that we do get out from the software is if a client did owe, is we do in fact get estimates, and their estimates for the next year are based on what you had for a tax liability in the prior year. So for example, if you had a tax liability of $25,000 in, 2024. Your estimates are going to be split over the 4 quarters. The 25,000 they're going to split over the 4 quarters of 2025, and that's what you would end up paying. When it comes to calculating penalties and interest, typically the penalties and interest calculations are based on the fact that you underpaid at the minimum what the prior year's tax liability was, and that's how you kind of get around at least paying penalties and interest. We still have clients who still remit checks. So sometimes we are still providing clients with actual paper coupons. Many of our clients have actually moved to either irs.gov, or if you're paying electronically with EFTPS, EFTPS keeps a record of your contributions. I personally like EFTPS a little bit better if you are someone who's actually is needing to make those quarterly estimates. You can go in and you can schedule them in advance, those kinds of things. Unfortunately, if you go to irs.gov, you're making your contribution right at that moment. So EFTPS gives you a little bit more flexibility. So basically, what we typically do with our clients now is, because our clients are business owners, we are actually pulling estimates on what we think they truly will have for income from the year. So, for example, if you are an S Corp, we're looking at what the owner is on for payroll for the year. Maybe the owner has a spouse, so we're looking at the spouse's income, what they earned last year, and then we're taking what we think the business will earn, the income that will pass through to the owner, and we're trying to get to a relatively rough calculation. So we're taking projected income, what we think their deductions probably will be, because there'll be some basic ones we're going to see on the tax return year over year, and we're going to multiply it by the tax rate. And then from there, we're going to give the client an estimate of what we think they're going to owe for the year. And then we do that on a quarterly basis. Again, looking for any major fluctuations. A client isn't actually doing the revenues they thought they were in their business, so we adjust down. Maybe client took on a really large project that we didn't expect, so now revenues have gone up significantly. We need to adjust that estimate in the next quarter and in the following quarters in order to adjust for that. So it's really important to kind of get that as close to the actual as possible. We try to do that, as I mentioned, on a quarterly basis, with the last estimate for Q4 with a relatively kind of final figure that we've determined at year end for that client as to what the income will be for the pass-through, and then we try to get something as accurate as possible. If you are a self-employed individual, so if you're a Schedule C, if you're a single member LLC that is filing a Schedule C, or if you're a partner in a partnership, right? What you want to ensure is that you understand what your self-employment tax liability is going to be. And then on top of that, your income tax liability, because you are paying both of those when you are self-employed. So you want to make sure you're considering those in your calculations when you're developing out what you think you're going to owe on an estimated tax perspective. I would say rule of thumb, when you are putting money to the side, what we tend to do with a lot of our clients is we're recommending that they're putting to the side 25 to 30%. That may seem like a large sum of money, but once you start to put in self-employment tax, income tax, many of our clients are actually in states where there is an income tax. So that is a nice rule of thumb. Is it perfect for everyone? No. And then as we work with clients longer, we typically will go in and we'll figure out from at putting the money to the side, because some of the clients actually like to put their money to the side as they work, month over month over month, so that they don't have to come up with a bunch of money at the end of a quarter. So again, they're kind of putting their money to the side throughout the months so that they have the funds for that quarterly. We tend to kind of dial it in a little bit more once we've gotten to a point where we know a little bit more about the client. And then from there, we can adjust kind of what we think they should put to the side, whether it's, 25 to 30% of the gross of the net of the business, or, maybe it's a smaller and it's 5% of every dollar brought in, right? We start to play with that a little so that we can give a client a rule of thumb. And for those that, don't really want to have to worry about that tax liability, they're very comfortable putting, say, 5 cents of every dollar that they earn, into over to the side to potentially cover any tax liability they may have. Again, that's not for everyone. It's something we tend to play with and tool around with once they've been clients for a little while. And we've gained a better understanding kind of what their overall tax picture is and what we think will happen for them on an annual basis. So let's talk about due dates. So the dates aren't actually exact quarters. So it's not, March, June, September, December, like you would think calendar quarters. So your first estimate is going to be due on April 15. So think of it this way. You're filing your return by April 15, and that first estimate for that year is due then. Now, the next estimate, Q2's estimate, is going to be due on June 15. Q3 is going to be September 15. And then the last one is actually going to be due on January 15 of the next year. So you're not getting exact 3-month quarters. So you want to be mindful of that. But what's nice is that the last one is actually in January, where you've had a chance to firm up what you think your final numbers for the year could be. And again, get as close as you can from, kind of a math perspective is what you think that number is going to be, and then remit that as a final. As I mentioned, you can go directly to irs.gov. It is, I think it's called Direct Pay. As I mentioned, EFTPS, that's an option as well. That'll require you to go in, create an account. Once you create the account, EFTPS sends you a confirm letter with an activation code. So EFTPS might take you a week or two to get set up, whereas irs.gov, you can just go on right away, make that payment right then and there. The difference between using the direct pay on the website or EFTPS, as I mentioned, is EFTPS does allow you to schedule it out. So again, you could put it in, on, September 1st, what the number is going to be, but you actually don't have it processed until September 15 if you wanted to. So it gives you a little bit more flexibility. Some people do, in fact, still mail in checks. Nothing wrong with that. Just be mindful that you want to make sure you've got proof of those things being sent in. Sometimes depending on what's going on with any one of the tax authorities, not just IRS, even sometimes on the state side, we have found where checks don't clear for a significant period of time. It's something to think about. Stuff does get lost in the mail. That happens as well. So again, I do still have clients who would prefer to mail a check. There's nothing wrong with that. You just want to make sure when you do send your check, you send it with your little paper coupon that has your name, your social security number, and then you do want to make sure you include your name and your social on your check, again, just in case they do get lost. We don't want that to happen, but again, once it leaves your hands and goes through the postal service and then goes to the service, you just want to make sure that you kind of take care of any things that could potentially become an issue down the road for you. But again, mailing checks, there's nothing wrong with it. I'm a big electronic person. If you've watched any of our videos, I like to do things electronically. Again, some clients do not. So that becomes a personal preference. So let's talk about avoiding penalties and common mistakes that come with your estimates. So people can underpay their penalties, right? That happens all the time. And again, you're going to pay penalties and interest on what you've underpaid, right? So when it comes to figuring what they call the safe harbor rule, you need to pay at least 90% of your taxes for the year. And then, or you need to pay at least 100% of the prior year's tax liability. So that's why in some cases, when you aren't doing all the calculations for a client on a quarterly basis, a lot of times what comes out of the tax software at the completion of return in terms of the estimates and what's listed on the estimates is actually a good option, and it is a good rule of thumb for many clients. Again, with our clients and income fluctuating in terms of the businesses fluctuating, we try to get as tight as possible on what we think that quarterly will be. And so we do tend to run it a little bit tighter than that versus taking 100% of the prior year's liability. But if we're just looking to minimize or eliminate penalties and interest, that is, again, one of the things that we'll work towards doing. Again, you want to track, like anything else, when it comes to business revenue and expenses, you need to keep track of them and you need to keep them up to date. we can't do a relatively accurate estimate of what we think your tax liability is going to be if your financial statements from the business perspective is not up to date. So you need to keep track of your income and your expenses and keep it up to date. Um, as always, I always recommend whether you work with a CPA or an EA, consult with them on a quarterly basis if they need to, create estimates for you at that moment for that period. Then that's really the most important thing as well. Like try to get as accurate as possible. No one wants to overpay. And so that's part of the reason why we try to do as accurate as possible of an estimate. Again, it's not perfect. Things do change with the clients throughout the year. So again, that Q1 estimate might be off because we have an idea of what we think the client's going to do for the latter part of the year. But if something shifts in that, it changes the assumptions from that Q1 estimate to that Q3 or even that final Q4 estimate that's remitted. Some tools and strategies that you can use for easy tax management. Again, as always, set up separate bank and credit card accounts. Keep track of it separately. That way you don't have it commingled, trying to pull business expenses out of your personal accounts and so on. You want to keep your business information up to date. Again, how do you do that? We happen to use QuickBooks. It is not the only one on the planet. There are other ones. There's Xero. There are smaller ones like Wave or FreshBooks. There are a number of options. You just want to keep your business financial information up to date so that when you are doing a calculation or your CPA or EA is doing a calculation for tax, it can be as accurate as possible. Like anything else, you want to automate your payments and your reminders. So your estimate, your Q2 estimate is actually June 15, which is not what someone would typically expect. So you'd want to have a reminder like, oh, you know what? I need to make sure that I make that estimate because it's not necessarily the end, that true calendar quarter end. You won't expect something like that. So those are the types of things you want to make sure you have, reminders on your calendars to make. As always, work with a CPA, an EA, somebody who understands the tax rules so that you can stay compliant. You want to make sure, again, something silly. We don't want to see clients pay penalties and interest for underpaying their liability, especially when, it just requires us to have a couple of touch points with them during the year. It's a lot easier, there's no need to spend that extra money and send that extra money to the service or even to your state, especially when you've stayed in contact with your CPA or your EA throughout the year to make sure that you're running as accurate as possible when it comes to creating your estimates. If you guys have any questions, please drop them in the chat. We'd love to hear from you. As always, I look forward to seeing you here every week. Feel free, we would love for you to follow us. Follow us on Facebook, Instagram, and YouTube. We are the Construction CPA on all three. I look forward to seeing you here every week. Have a wonderful weekend, and we'll see you next week.